Hello, everyone. I'm Chris Kapches, the CEO of Chestnut Park Real Estate, and today I'm going to be providing you with the July market report for the Toronto and Toronto region. Um, for those of you that have been following these market reports, there's going to be no real surprise as far as the July data is concerned. It's basically a continuation of what's been happening over the last few months. And probably the best way to characterize it is to talk about the pattern that has emerged as we get just past the halfway mark of the year. There's sort of four themes that are coming out of this market data, and if we're going to characterize them, and I'll talk about each one of them individually, is that we've seen growth in sales as the year has gone on. The growth has been modest, but we have seen growth. Particularly when we compare it to the tail end of 2024 and the early part of 2025. That's one theme. The second theme is we're seeing modest price reductions, and we saw it again in July. So whereas sales are going up, we're also seeing the average sale price come down. The other theme that is emerging is large inventory levels, larger than we've seen in probably more than a decade and probably even longer than that. And then the fourth theme that is emerging is properties are staying on the market much longer than we are used to in the past. So on the screen, you'll see the kind of more salient aspects of the marketplace. But let's talk about the various themes. So sales went up in July. We came in at 6,100 sales, which is almost an 11% increase compared to last July. So that again, you can see the pattern. They're going up compared to last year. The price reduction, the average sale price came in at $1,051,000. That's almost a 5.5% decline in the average sale price. And over the last few months, we have seen that happen consistently. And I'm of the view, and I think it's shared by others, particularly economists, that we're going to continue to see that for the remainder of the year. Probably will stabilize near the end of the year, or certainly by the early part of 2026. The other area is inventory levels. At the end of July, we had over 30,000 active listings. Somewhat deceptive, that number, in that there's a lot of properties that are relisted that were previously on the market and are not new listings. But notwithstanding that, there are over 30,000 active listings. Only a few years ago, we were averaging about 15,000 listings at this time of the year. So we've more than doubled the amount of listings. Of course, when you have that many listings, buyers have time and they have choice. They have time because they're not rushed to make decisions. Because there isn't the same pressure as when we were in the heyday of multiple offers, and also they have choice. There's so many properties to choose from. They ultimately find the one that they can negotiate the best deal with, and they purchase that property. And then the days on market. So we are now averaging about 30 days on market. Wasn't long ago that we were in the high teens, and when we were at the peak of the COVID market, we were actually in the very low 11, 12 days on market, in some cases even less than that, and certainly in some neighborhoods, Riverdale, Leslieville, the Beach, some cases there were 7, 8 days on market, and properties would be gone just like that. That's all changed. So longer periods on the market, much more inventory, declining average sale prices, and we are seeing modest growth in the actual sales numbers. So in a sense, it's as if the market has come to the consumer, not the consumer coming to the market, not the buyer coming to the market, but the changes in the market have come to buyers, and buyers are now participating. But they're participating on their terms as opposed to the past when they were being drawn into the market by the very fervent conditions that existed at that time. And why is this happening? Well, ultimately, it boils down to affordability. Mortgage interest rates, 5-year fixed terms, are still around 4.5%. Doesn't look like they're going to be coming down. In July, the Bank of Canada met on July the 30th. It did not reduce its bank rate, but even had it reduced its bank rate, because of all the economic turmoil that's going on, the bond yields remain strong and seem to be getting stronger. And it's the bond yields that are actually determining the mortgage financing market. And since the bond yields are strong, then we're seeing a lot of impetus to keep mortgage interest rates high. So affordability is the issue. What can give? The only thing that can give is average sale prices. And we saw in July average sale prices decline in almost every type of housing sort of genre. And the worst decline, of course, was in condominium apartments. And I should mention before we close out on this market report that the bifurcation that I've talked about on numerous occasions in the past continued into July. And by that bifurcation, I mean the difference between the way the 905 market is working and the 416 market is working. When we look at the decline in average sale prices, we see that there was a greater decline in average sale prices in the 905 compared to what was happening in the 416. And again, I think that is a kind of a post-COVID correction. Whereas people during COVID moved out into the suburbs for more space, for sanctuary, that's being reversed now, and people are once again looking to all of the kind of amenities and attractions of living in a city compared to the sort of suburban areas, the 905 region. And I think that pattern will continue. So as we look forward to the second half of 2025, all of these themes, the increasing sales modestly, the decreasing average sale price, again, modestly, high inventory levels, and longer periods for properties to stay on the market will be the themes that will dictate where the market goes throughout the remainder of 2025 and perhaps even into 2026. That, of course, is going to be the case, assuming that we don't have any geopolitical issues, particularly on the international stage, that might blow back and impact our economy. Right now, we're still groping with job losses, as we discovered in July. We'll have to see what happens in that regard, and hopefully there won't be any new uncertainties that might impact the market. Otherwise, it's going to move towards stabilization, is what we need more than anything. And hopefully that stabilization will lead to a much stronger market as we move into 2026. So until the August market report, stay well, and I look forward to presenting it to you when we get the August data. Thank you very much.